Here we go. 3 dividend stocks that I like right now. Our first stock is down 24.97% so far since last year. But on a year-to-date basis, this stock is actually up over 6% right now. And here's the deal. When it comes to this video, when it comes to what you're going to get out of this, and hopefully going forward on this channel, I'm going to present this in a way that I don't think I've seen anyone do on YouTube so far. So I want you to hopefully tell me in the comments if you do like the way I present this, because it's very unique. And I'm going to distill this. This is a 10Q. This is a quarterly filing that every company is going to put out every quarter. And so here's what I did for you people. I created a graphic. I think that this is the best way for a lot of people, probably anyone watching this right now, who has a bit of a left and a right brain together, who are going to want to figure out the revenues of a company and how you get to earnings of a company, or earnings per share, or net income, whatever you want to call it. This is how you're going to do it. So what I did was, this is the actual income statement from the 10Q. We're looking at 9 months ended September 30th of 2022. I'm going to point you to a number here. We're going to look at total revenue, net of interest expense, and this is going to be $70.418 billion, basically. And so here's the graphic that I've created for you, and take a look at this number right here. $70 billion. So what is this telling us? This is telling us all of the revenue on the company. On the left side of here, this is just revenues of the company. So let's just focus on this first. So these are all the different segments of revenue that the company makes. And I think it's important to always look from the top down when you start and you understand where revenues actually come from for a company. That's one of the most important things that we're going to want to know. So for this company, $28 billion or 40% of its revenues comes from consumer banking, net of interest. So we're talking about like card income, maybe credit card income, services charge, things like that. And this is up 11% year over year. So this aspect of the revenue, this segment is actually up 11%. So we know that this is a good revenue segment because it's up so much. Revenue here, net of interest and expense, 70 billion. So you'll see this flows into this area, the $70 billion of revenue. The next part that flows in here is $14 billion of revenue from B of A, Bank of America Private Bank. Okay, I gave it away. This is the stock, Bank of America. Global Wealth and Investment Management. This is these two parts of this segment of revenue is here. Merrill Lynch is also in here, and that's $3 billion of revenue. So Merrill Lynch is actually not that big of a portion of revenue of Bank of America. But again, we could see B of A Private Bank up 6%, Merrill Lynch up 11% year over year. Again, remember, this is the 9 months ended, so not a full year, but it's basically how much it's up over the year prior. Then we have global banking. So this is going to be like service charges, investment banking. So this is the revenue that's going to fall into this segment of income, and that's 16 billion or 22% of the revenue. And then we have global markets. That's 14 billion, and 14 billion is 20% of the overall revenue here. And we actually have a negative revenue thing so they book this as negative revenue. So it's an all other is actually a 5 billion of negative revenue for the company. Okay, let's look at the whole graphic now. Okay, on the left side, we have all of the revenues. They flow into this big bar that shows you how big the revenue is for the company. And then that bar is going to be broken down into the other parts of revenue. So this green line, as you follow this, you're going to get to net income over here. And along the way, you're going to be chipped away basically at the expenses of the company. And so that's what's so good about this graphic is it allows you to see how big the different portions of expenses are, how much they've grown year over year. It tells you so much. And so the way we actually read this is all of this 70 billion minus these numbers is going to give you 23 billion. Then you're going to go down here. We're going to take income tax, $3 billion. It's actually up 124%. And then you have preferred stock dividends up 9%. So those two, so you subtract those from income before income taxes, and then you get the net income for common stockholders. This is $19 billion, and it's actually down 20%. So what is going on here? Well, basically we have this provision for credit losses. This part's probably going to be one of the things that kind of weighed a bit on the bottom line of the company, on the earnings of the company. Why is that? Well, because we could see revenues were actually up 5%. So the expenses actually pulled down when we got over to net income and income before income taxes. So I'm going to tell you what I think this company is worth, and I'm going to talk about the dividends. And by the way, I do own this company. We're going in terms of the size of the dividend, basically. So this is the smallest dividend of the stocks I have today. A dividend 2 years, it's increased its dividend 2 years in a row. The dividend yield is 2.47%. The dividend growth has been 9% over the past 3 years. The payout ratio is 27.59%. So that's based on the earnings of the company. Let's talk valuation. Okay, so what did I get for my value for this company? Well, the answer is I got a $51 price target for my company here. And to me, it's got an upside of 43%. So Bank of America, I think it pays a decent dividend. I think it has good upside potential. And I like the stock. Okay, here we go on our next stock. This stock is down almost 13% so far over the past year. Year to date, this stock is actually down 3.5%. So unlike Bank of America, that's actually up so far this year, the stock is down a bit. Okay, back over to our income visualization. I think that you understand this graphic now. I hope you do. So here we go. We got the revenues, 239 billion in revenues. Tons of revenue for this company. This is over a 9-month period ending on September, the end of September of 2022. This is the 10Q. I don't have this information for the whole 10K yet, for the whole entire year yet. So I'm using the 10Q. Here we go. Pharmacy services is where this first part of revenue comes from. 125 billion, 53% of revenues. This is up 10% year over year. So good growth here. We got retail or long-term care pharmacy and front store. This is up 7% year over year, 78 billion of revenue, and it's 33% of revenues. Then we have healthcare / health insurance premiums. So we have up 11% here, 68 billion of revenue, 29% of revenues. Then we got corporate or other. This is 0.4, so $400 million, and it's only a very small portion of revenues. And we have this thing called intersegment eliminations, and this actually was booked as negative revenues, and it's pretty big, negative 34 billion here. So this actually weighed on the revenues. But at the end of the day, revenues actually for this company at 239 billion were up 11% year over year for that 9-month period. Now let's see how this flows over again to get to net income. So we're going to stop along the way at operating income. And how do we get that? Well, we have these expenses that we need to take out of revenues. So what are those expenses? Well, we have the cost of the product sold, 145 billion. Look, this is up 12%. Inflation, people, right? We're talking inflation probably here. So yes, there's a lot of inflation in the economy. Benefit costs 53 billion. That's up 11% also. So also going up. And then we have costs of something called other. And then we have this interesting one, opioid litigation charges. This is the one that I want to really focus on this video, because I want you to understand that this $6 billion is probably kind of a one-off thing. Hopefully. They had to do a settlement and they paid $6 billion for that settlement, and all of that money should have now been booked and off of their income statements going forward. This gets us to operating income of $4 billion. It's down 62%. So what we need to understand is once this does not happen, let's say next year, we would hopefully not have a negative $6 billion here, and hopefully this number would be much higher. And then going down over to net income, interest expense here, it's actually down 18% year over year, so that's really good. Interest is going down, the interest they're paying on their loans, and that's obviously a good sign. We have income tax expense also actually down, a little less money here, but again, net income is $2 billion and it's down 72%. Okay, it's time to reveal the company. This is called CVS Health. I'm sure you've heard of it before. If you're from the US, CVS drugstores, pharmacies, they're all over the place. Biggest competitor, probably Walgreens, right? So CVS Health is the one we're talking about here. Let's talk about the dividend. So CVS Health has increased its dividend 1 year, so not a very lengthy time, of course, of dividend increase record. It does pay a 2.7% dividend right now. That's the yield on the dividend, and we got dividend growth for the past 3 years of 4%. Not too much growth, but okay, it's all right. And we got a free cash flow payout ratio of 16.88. Basically, what percentage of the free cash flow is being paid as a dividend, and then when you add in buybacks, it's pretty low. So basically these are low, and I kind of like to see that when it's lower, because it means they could probably continue doing this and maybe even increase the dividend going forward. What price did I get for this company? An $118 price target. That's up about 31.61% upside potential for this stock. So get a decent dividend, not too bad. You get some decent upside potential. That's how I'm looking at it. And that's why I like this stock. Okay, and our last stock here, I own this stock. I did not own the last stock I talked about. So the second stock I did not own, this one I do own. So this one's actually down almost 25% so far for the year. So far year to date, the stock is flat. It's down 0.27%. So let's just call it flat. And of course, we have an income visualization for you that I made. This one, I think, is a very interesting one because there's two different big segments, and then I actually broke it down even further. So we have the consumer segment, and we have the business segment. This stock has consumer. It's got service as number one. That's 9% up for the service revenues, and that's 54% of revenues. Then we have wireless equipment. This might be giving it away. That's up 24% year over year, 16% of revenues. That's 17 billion. Then we got other at 5 billion and 5% of revenues. Okay, we're going down to the business section. Okay, and as you can see, consumer part is actually a lot bigger than the business part. Probably 70% of revenues are going to come from here. Maybe the other 30% are going to come from here. So we got small and medium businesses. Okay, so let's call it wireless for these different businesses. I'm not going to give it away yet. We got 9 billion. That's 9% of revenues. It's up 8% year over year. We got global enterprise. That's up 5% year over year, 7 billion and 7% of revenues. And then we got public sector and other. That's down 5% year over year for these revenues, 5 billion and 5% of revenues. Then we got wholesale. This is down 5%, 2 billion of revenue, 2% of revenues. And then we got finally, we have corporate and other, 2 billion of revenues and 2% of the revenue. Actually, this one's down 74%. So over here we have total operating revenues, 102 billion, up 2% year over year. And again, we can see how this flows over to net income. And on the way to net income, you stop at operating income. And what do you have here? Well, you have these expenses minus this gets this. Operating income is actually down 6% year over year. One of these is actually a pretty big expense that was up. So cost of wireless equipment, 22 billion. That was actually up 28%. We also have SG&A, selling, general, and admin. That was up 4%. And then we also have down here cost of services, 21 billion. That was down. Then we have depreciation and amortization, 12 billion. That's actually down also 13%. Look over here, we get net income. Net income is down 16% at $15 billion. And then we have income tax, 4 billion, interest expense, 3, and other, 1 billion. One interesting thing to maybe take a note of with this company, and here we go, I'm going to reveal it right now. This is Verizon. So Verizon Wireless, you might have heard of it. If you live in the US, I'm sure you've heard of it before. Huge cell phone provider. You can go out, you can get a cell phone, you can get your plan with them. You can sign up with your home, you can get internet with your home, you get internet with your business, right? So you've probably heard of this company. So let's talk about the Verizon dividend now. Okay, so for Verizon's dividend, it's actually paid a dividend for 18 years. It's got a really good dividend yield, 6.52%. So we're talking good dividend yield so far for this company. We got 2% growth in dividend over the past 3 years. Not that great, of course, but look, we got a good dividend yield. It's been increasing over 18 years. The free cash flow payout ratio, kind of high. And then the dividends and the share buybacks are a little bit high too. So, they're spending a little bit of money in terms of the free cash flow towards their dividend. So, you would want to hope that the free cash flow is going to increase so that they can sustain this. All right, for the price target, $55. What's that give us? It gives us a $45 price target. It's going to be an upside potential, about 11.22%. A little bit of upside potential. You're getting a great dividend with the stock, though. So that's also something to factor in. Over 6% dividend yield. And these are 3 dividend stocks I like right now. Thanks for watching. If you like this video, I have another video on Apple and I have a video on Microsoft if you want to see my price targets for those. And disclaimer here.